it doesn't matter what time frame you trade. What matters is, are you comfortable? Are you successfully profitable? And don't worry that somebody else, if I'm trading the 30-minute chart, this other guy trading the 5-minute chart is going to make more money than me. Who cares, right? You're doing it to make money for yourself. You're not doing this to make more money than somebody else. You're not going to make more money than Ken Griffin. You're not going to make more money than Warren Buffett, right? There's always going to be somebody who does things better and makes more money. Your goal is to be happy and successful, and don't worry about, if your comfort zone is trading a 15-minute chart, or if your comfort zone is trading a daily chart or a weekly chart. It doesn't matter. Find a comfort zone where you can trade profitably, and you're going to make a ton of money.
Mr. Al Brooks, welcome to the channel. Thank you for stopping by.
Thank you for having me, Aaron.
Yeah, it's very good to have you here. And I should say Merry Christmas, because it's 'tis the season.
Yeah, Merry Christmas to you too.
Yeah, thank you. Thank you. How is your trading looking around the holidays? Do you tend to take some time off, or do you find this to be a good time to be on the screens?
Well, the week between Christmas and New Year's is usually about the slowest week of the year. And, I plan vacations throughout the year. And, my kids, I got 5 kids, and they're all adults, and several of them have their babies. So I try to be around Christmas because I want to see them all when they visit.
Sure.
And a lot of times they don't let me know until a day before. Dad, we're coming over. So I want to make sure that I'm here.
Very good. Very good. Yeah, you just have to be on standby then. So if you jet off the screen during our call, I'll know that one of them hit you up and they're on the way.
That's right.
Very good. Well, I said in the beginning, but just as maybe an introduction, or just as my first words, we just turned on the camera and this is our first words to each other. And when I think of Al Brooks, I think of the godfather of price action and just pure price action and chart reading. And it's very interesting to meet you. I'm very much looking forward to picking your brain and to hearing from you and just hearing more about your story. And I'm excited to see where this conversation goes. So once again, a big thank you for stopping by. And as we do jump into it, would it be okay if we just start off with maybe in your own words, how you would describe your approach to the market?
Yeah, I'm kind of an arrogant guy, but when it comes to the market, I'm very humble. I always assume that there's an institution taking the opposite side of every trade that I take, and therefore I can't be 100% certain of anything. In general, I look at 95% of the bars on the chart as having a 60 to between 60 and 40 and 60% chance of going one way or the other way. 5% of the bars on the chart look like what we had at the end of today, where the market just collapsed. Okay, so 5% of the bars in the chart are very high probability that the market is going to do something. And early on in today's collapse, the probability was 70 or 80% that the market was going to keep going down. But for most of my setups when I'm trading, I assume there's no worse than a 40% chance that I'll win, and no better than a 60% chance that I'll win. Because there has to be a reason for somebody to take the other side of the trade. So, if I think I'm 70 or 80% certain, I never think that way. I never think, I have guidelines that let me know when I'm wrong. For example, if I was long right before today's collapse and I saw 2 big bear bars on the 5-minute chart closing near their lows, both closing below the moving average and the 20-bar exponential moving average, and the body of the second bar was completely below the moving average, I know there's a 60% chance of a bear trend. In other words, many bars going down. And once you start to get a third and a fourth bar and the bars start getting bigger, the odds are 70% chance that the market is going to keep going down, or at least 70% chance. And when I say keep going down, I think in terms of measured moves. So the open of the first bar over the bear breakout to the close of the most recent bar of the bear breakout, the market has a 70% chance of falling that much further. And if you get 3 bars, it's the open of the first bar to the close of the third bar. If you get 3 big bear bars closing near their lows. there's a 70% chance it's going to go that distance below that final close. So today's a special day. It's unusual to have that kind of a collapse like we had. But for most of the time when I'm taking trades, I'm always assuming I'm going to be at least 40% right. 40% of the time, I'll end up with a profit that is maybe twice my risk, and usually not more than 60%. So, and also I'm very quick to change my mind, and I'm never married to any position. If I look at the chart and I think, yeah, it's a reasonable buy setup, I'll take the buy setup. But if I become disappointed, I'll get out. And sometimes if the market disappoints me in a very strong way, for example, let's say I buy and I see two big bear bars closing near their lows, I'll probably get out before that. But if I see that, I'm probably going to get short. So, I'm very quick to discard whatever opinions I had a minute ago. Every new tick that I see is more information. And with that more information, I reevaluate, what do I think the market is going to do?
Okay, very good. There was actually quite a bit to unpack with that. When you're trading, you definitely mentioned quite a bit of structure, but also some, I think, independent decision making. Would you consider yourself more on the discretionary side of interacting with the market, or more on following the process side?
I think anyone who's trading, everyone has a system. Everyone has setups. Okay, so I have a bunch of things that I know. When I see certain things, I know I can. If I can, I see trades on almost every bar, right? And I use discretion. Some I take, some I don't take. So I think of myself as a discretionary trader, but all discretionary traders who are profitable have some method to what they're doing. So they look for setups, and they don't necessarily take every setup. And I do see setups on every bar. On a 5-minute chart on the E-mini, there are 81 bars in the day. And on every bar, I see something I can do. I can buy, I can sell, I can use a wide stop, I can scale in. I see something that I can do on every bar. And a lot of times I can see both a way to make money selling and buying at any given moment. And then it comes into management. Do I use a wide stop? Do I scale in? And I don't take 81 trades during the day. But, I try to take 5, 10, 15 trades on an average day. And I just, plus, you got to eat lunch, you got to go to the bathroom. Sometimes your kids call or your grandkids call. So there are little windows in there where it's just dead time. And when those windows are over, I just go back to work. I just start looking at the chart and try to figure out, what's the chart telling me? What will the next bar and the following bars do? And I'll also take trades that are relatively low probability. For example, a 40% probability is relatively low. But if you go for a reward that is at least twice your risk, that's a profitable strategy. Even if you win 40% of the time, you're going to make money. And if you can make, like today, at the end of the day, you can make many times greater than your risk. And trades like that, even though when you initially take the trade at the top of the day, there was a major trend reversal. I describe it as a higher high major trend reversal or a final flag reversal. And there was a second sell signal bar. If you take that, the risk was not all that small. And I didn't hold for the whole thing, but if you held for the whole thing, I tend to get out and get in. But if you held for the whole thing, you would have made 20, 30 times your risk. And that greatly, if you're trying to win 40% of the time and you're trying to get a reward that's twice your risk, occasionally you're going to get a reward that's 5 times your risk or 20 times your risk, and that really helps your profitability.
Yes. So when you are coming into the day and you're planning out your trades, do you have like the E-mini S&P as the one thing you focus on, or how many products are you trading?
I trade bonds, I trade gold, I trade crude oil, I trade a lot of stocks, but most of what I trade is the E-mini. And the reason for it, there are several reasons. One is it can handle any kind of volume. And any size trade that you want to make, the E-mini can just swallow it up, and you won't even move the market. So I never have to worry about size. If you're trading stocks, especially stocks that are thinly traded, you have to worry about manipulation and size and bad fills. And I don't have to worry about that with the E-mini. And then also, I like feeling like I'm connected to the market, that I'm part of the market. And the E-mini is, it's basically the S&P. It's the underlying is the cash index of the S&P 500, and that is the market. So I feel like I'm playing with the big boys. It makes me feel like what I'm doing is significant. Also, I like the idea that I can take money from the institutions. They have really good traders. Well, I think I'm a pretty good trader too, and so I like the challenge.
Very good. When you are looking at these and deciding what you're focusing on for the day, how do you refine down what that looks like for you?
Most of the time, I'm going to start the day looking at the E-mini, and I'll have on one of my charts, I have lines of important prices. For example, I always have a line across yesterday's high. I have a line across yesterday's low. And if there's some significant high from a week or two ago, or a month or two ago, or 6 months ago, I'll have that drawn on the chart, because those prior highs, prior lows are all significant. And I also have a line across the chart for the Globex high and the Globex low. I trade the day session chart, but 90% of days will break out of the Globex range. So if the market is starting to go up toward the top of the Globex range, I'm much more interested in buying. And if it gets near the top and reverses, I'm very interested in selling, just like with any other support and resistance. And then there are all kinds of other little magnets throughout the day. For example, if the day is mostly a trading range day and the open of the day is in the middle of the day's range, the day is normally going to try to test the open later in the day. Most days try to close near the high. Most days try to close near their low. If they can't do either, they try to close near the middle. So I also, at the end of the day, pay attention to the exact midpoint of the day's range, because that's another magnet. There are a bunch of little things. And then also you got diagonal trend lines drawn across lows, diagonal trend lines going down across highs. There are all kinds of things that I look at on the chart as magnets. The market tends to get drawn to them. And then you see what the market does when it gets to them. And I either look for a breakout or a reversal. And I said something really important a few minutes ago, and I'm going to say it again. For a breakout of any support or resistance, I talked a few minutes ago about breaking out to the downside during today's collapse. If I see a bull breakout, for me, a bull breakout, the minimum needed is a bull bar with at least an average size body closing near its high and closing above the high of the prior bar. Okay, so anytime I see a big bull bar closing on its high and closing above the high of the prior bar, that's a breakout. And what did it break out of? Well, at a minimum, it broke out above the prior bar. And if you look to the left, there might be another high that it broke out above. And if I see a second bull bar closing near its high with a relatively big body, so now I have two closes above that resistance. And if the body of the second bar is completely above that resistance, I know there's a 60 or 70% chance the market is going to go up for some kind of a measured move. Okay, so if you get two closes above resistance with two consecutive strong bull bars, big bull bars closing near their highs, and the body of the second bar is completely above that resistance, there's between a 60 and 70% chance that the market is going to go up for some kind of a measured move. The bigger the bars, the more likely it'll go up for some kind of a measured move.
And I wrote that down when you were talking about the way it broke down from the bear side, to revisit, because I had some questions about this as well. When you are looking for, let's say, that breakout, are you weighing in contextually the fact of, let's say, if all it's doing is breaking through at least, let's say, that previous bar, or if this is having a breakout from some serious consolidation or above or below some type of a key level, will you increase the size or be more aggressive on those positions, or are you treating those fairly equally?
Normally, I think it's really easy to get distracted when you trade. For example, your grandkid calling you. There are all kinds of things that can distract you when you're trading. And therefore I try to minimize what I'm doing. I want as few moving parts as I can have. And what I talk about in my chat room is that people should have two sizes. They should have their normal size. And if the stop has to be far away so that their normal size requires them to risk more than 2 or 3% of their account, they need a second size. And I wouldn't have a third or fourth or fifth size, or I wouldn't treat it like it's on a sliding scale. To me, you have two sizes, your normal size, and if you don't take a trade because you're afraid, you have a second size. And how big is that second size? I recommend 20% of your normal size. So if you normally trade 5 E-minis and your stop has to be too far away and you don't want to take this trade, then you would trade 1 E-mini. You don't spend time thinking about, should I trade 2 this time? Should I trade 3 this time? That's a distraction, and that's a sign of weakness. And whenever you let yourself get distracted, if you're in battle, if you're distracted, you're gonna get killed, right? When you're trading, you have to be as mechanical as you possibly can be, and you want as few moving parts. And you can say, okay, if I trade 1 E-mini, I'm not going to make much money. Right, you take 1 E-mini, and if the market goes, let's say you buy, let's say it's a buy setup and you buy, and the breakout is very big. You trade 1 E-mini, and then let's say the market goes up the size of a scalp, and the E-mini now scalps are about 5 points. Okay, and then you get another bar closing near its high. What do? You buy more. And then let's say a few bars later, you get another bull bar with a decent sized body closing near its high. What do? You buy more. So you're scaling into a winning position. And, you were not able to take the 5 contracts initially, but you might get up to 2, 3, or 4 contracts. And given that since the bars are big, you could still end up making as much as you would on a normal trade where you would trade 5 contracts.
Sure. When you are sitting down at the screens and you talk about these magnets and these trade ideas, that you have either a statistical back-tested understanding of what's likely or some type of repeatable pattern that you've seen before, are these things that are a little bit intuitive to you, or do you have maybe a large library of these that you've built up over the years?
It's funny that you ask. I have every day, for 35 years now, since the 1980s when I started trading. Back then, I used to print out charts every day, and I used to look for patterns, and I'd look for every pattern I could find. And sometimes patterns would overlap, and sometimes a pattern could be classified as 2 or 3 different types of patterns. And over time, and I have backtested. I've spent, I don't know, over 10,000 hours backtesting things. So, I have the backtesting side of things. So I have a lot of experience with backtesting. And then beyond that, I just have personal experience, and I try to simplify things. Like I said, if your stop is far away and the bars are big, you have a 70% chance of making some kind of a measured move. Reward equals your risk, right? And if your probability is only 40% on a trade, like today at the top, that reversal had a 40% chance of leading to a swing down. And it led to a massive swing down. But when you first took it, it only had a 40% chance, right? So I pay attention to that. As far as patterns go, I have about 100. I said I used to print out charts every day. Now what I do is I screen capture charts, and I go through every bar on the chart and look for every reasonable pattern. As I said, I see stuff on every bar, but I look for the major things, maybe 5 or plus major things that happen every day. And I mark them up and I file them away. So, today at the start of the day, we had 2 consecutive bull bars closing near the highs on the open. That's a buy. So you buy above the high of that second bar. And then we rallied and then went sideways for a couple of hours. And if you have a very tight trading range late in the bull trend, it's probably going to be the final bull flag. So if you break to the upside, the upside breakout is probably going to reverse down. So when I broke to the upside and reversed down, the first reversal down did not have a good sell signal bar. But 2 bars later, there was a good sell signal bar, a bear bar closing near its low, and that's a sell. So that is a final flag reversal. And it's also a higher high that's reversing down, and a 40% chance of a major trend. So I would call it a higher high major trend reversal. And then we had a breakout below the trading range and below the 20-bar exponential moving average. Then it became a breakout trade. And so today, at the end of the day, I started doing this right before I joined this Zoom meeting. I created about 7 or 8 charts, and I don't have them fully marked up yet. And I'm going to file them away. And I basically have 400 categories. For every pattern, I have a bull pattern and a bear pattern. So if I have, let's say I have 100 patterns, which I approximately have, and then there's a bull or bear version, so that's 200. And then I have a successful and a failure, right? Every pattern can fail, and every pattern will fail at least 40% of the time. So that means I have 400 patterns, and I have an encyclopedia of chart patterns that I keep adding to all the time. And yeah, I make it available to people who bought my course. And a lot of them go ahead and buy access to this, and every day they see the charts that I mark up. I just share them with everybody. And I'm currently right now writing a massive book on chart patterns, an encyclopedia of chart patterns for day traders, and it's massive. You know, it's going to have. I have the text done, and I'm in the process of creating the charts. It's going to have about 2,000 charts, which means it'll probably be a 3 or 4 volume book. So when you're asking me, do I have patterns that I look for? Yeah, I have patterns. And do I classify my patterns? Yeah, every day I classify my patterns. And that's my homework. You know, if you go to a soccer game, the guys are out there playing soccer. What do they do the other 5 or 6 days? They're practicing, right? Football player, they play on Sunday. What do they do the rest of the week? They're practicing, okay? And I'm trading when the market is open. And what am I doing after the market closes? I'm practicing, okay? There are so many variations of every pattern that, you know, it's easy to miss them. A lot of them, you look at it and you say, that's not a wedge. Well, it is a wedge. If you know what to look for, if you realize, if you don't understand what the market is doing, that is a wedge or some kind of a wedge. And so I look for every little variation every day. And that way there I have them fresh in my mind. And as I see things unfolding during the day, I'm always asking myself, Al, you know, could this be a final bull flag, like that rally on the open, and then we had the trading range? This could be the final bull flag. So if we get that upside breakout, I'm going to look for a reversal down, and I'm going to go short. So, and so the fresher you can keep all the things in your mind, and the more variations that you see, and that you understand that they're variations, the more trades you're going to see. Also, if you have good management skills, you're never going to get burned, right? You know, there are always fail-safe ways. You know, you always have a stop, but sometimes the market does something before your stop is hit that disappoints you enough that you want to get out. Well, for example, let's say you buy a bull trend, and there's then a bear bar with a decent-sized body closing near its low. You know, I will get out below that bear bar. And if there are consecutive bear bars closing near their lows in that bull trend, now it's a 50-50 chance you're in a bear trend. So, you know, I'm probably going to short below the low of that second bear bar. And I'm not going to wait for, if I have a stop at the bottom of the most recent bull leg, I'm not going to wait for that stop to get hit. I'm going to get out of long, and I'm going to get short. So there are a whole bunch of things that you just get from it. I want to talk a little bit about patterns, okay? When traders trade, if they're looking for reversals, they want to see a test. And the most common test you get is a double top, right? So the market rallies, it sells off, and then it rallies again up to around the prior high. And once it's there, you look for another sell-off. Like, for example, in the S&P cash index right now, we're testing the January 2022 high. That was the all-time high, and we're getting near it. And what did today do? It collapsed, right? So you want to see what the market does when it's near a prior high, right? There were bulls who bought that rally up to January of 2022. There was a very strong bull trend. They were buying, and somebody bought the final close on the daily chart, weekly chart, monthly chart there. And some of them decided that, yeah, I'm an investor. I'm going to hold long even if it sells off. And it sold off a lot. But if you're smart, you buy more. Let's say it sells off a long ways, and then it starts to create bull bars closing the other highs. You buy more. Why is that? Because if you have a really strong trend, a buy the close type of trend, a trend where you can just buy closes all the way up, and it suddenly reverses, and you have no opportunity to get out. So you have a big bull trend, you get a bear bar, and then the next bar another bear bar, and never had a chance to get out break even. All right. Some bulls are going to wait for the sell-off to keep going down, down, down until it gets another bull bar. And eventually you will get a pretty good bull bar. And what happens if you double your position above that bull bar? There's an 80% chance there's going to be a rally that will go at least one tick above your average entry price. Okay. And there's a 60% chance the market is going to go all the way back to your first buy way up at the top, January 2022. So if you're trading a monthly chart, and you bought January 2022, and then you bought more of a big bull bar last October, 80% chance it would go to at least one tick above the midpoint, which it has done, and a 60% chance that we get all the way back up to that January high to test that high. And when it gets there, a certain number of bulls are going to be so disappointed by the sell-off in 2022 that they're going to exit. And if enough traders exit, and enough bears say, yeah, I doubt we're going to go much higher, enough bears short, you're going to reverse down and you'll have a double top. And if instead the market does not collapse, the 5-minute chart collapsed, but on the daily chart it has not yet collapsed. If it goes sideways and starts to work higher, you could go quite a bit above that resistance. So instead of a double top, you get a successful breakout. So I'm always looking for tests of prior highs. So double tops are really common. And then wedge tops, you get 3 pushes up and then a reversal down, right? Wedge bottoms, 3 pushes down and a reversal up. And you can say, wow, you just said everything's a test. And a double top, I can see that the second high is a test of the first high. Now that's an obvious test. On a wedge top, where's the test, right? Well, a wedge is a bull channel that is contracting. A wedge rally is a bull channel that's contracting. And once you see the first 2 pushes up, you draw a line across those 2 highs and extend that line up and to the right. And that is what gets tested. So in a wedge top, what you're testing is the top of a bull channel. So there is a test. You want to see, is the market going to reverse down on that test of that top of the channel, or is it going to just keep going up? So if you look at the daily chart back in 2022, or the end of 2021, in my chat room, and also in my blog at the time, I wrote that this is a wedge top on the daily chart, and it could lead to a significant reversal. And we did. Nobody knew that the pandemic was going to be the trigger, but the chart was telling us that it was ripe for profit taking, and you could get a reversal. So, and why would we get a reversal on a double top right now? Well, there's always going to be a fundamental reason. And nobody knows what it is. It's usually a surprise, right? The market's going up because everybody's bullish, and if it's going to go down, something changed, and it's something unpredictable. Because if people knew it was going to happen, they wouldn't be buying. They're buying because they don't see any problems, so the market keeps going up. But there will be, if we do reverse down somewhere around 5,000 or 5,500 in the S&P. There will be some news event that will correspond to it, like something in the Middle East, something in Ukraine, China attacking Taiwan, which I think they're going to do, but I think they'll wait until after the election. So I think 2025, I think China will probably take over Taiwan, and that could be the excuse to get the market back down to last October's low, around 3,800, which is where I think we're headed in a few years. But anyway, I'm talking too much. Go back to your questions. So
yes,
yes,
no, it was good to let you cook. You did spark a lot of questions. And when you were talking about the trades that are moving against you and then looking for those reasons to add to those positions, is that more from like an investing standpoint or adding to positions that are going against you? Is this something that you recommend or that you do normally?
I do it. I think it's a good thing. And Warren Buffett a couple of years ago bought Apple, and Apple was way up when he bought it, right? And I read that he added to it 9 times over the past 2 years. And now it's his biggest position, and he's the biggest single owner of Apple shares.
Mm-hmm.
So there's nothing wrong scaling into a winning position. You know, Warren Buffett is a good example. You can also scale into a losing position. For example, Carl Icahn, who's a billionaire investor, when Freeport-McMoRan, ticker symbol FCX, about 5 years ago was collapsing. It lost like 80% of its value. And he started buying it around $10, and he started buying more, like down to $5. And I think, I forgot how many entries he had. He had like 7 entries. And then it rallied to $20 and $40. So, scaling into a losing trade, if you have a big enough account and you trade small relative to your account, that can be good. And scaling into a winning trade can also be very good. So I do both.
Very good. Yeah, I think and let me know if you agree with this, as a general rule, there's a fine line between building a position and then just being contrarian to what the market is telling you and adding to a losing position that maybe for let's say the average trader, even put myself in that category, that is a very quick way to just do incredible amounts of damage. For the average, let's say retail trader, would you advise against adding to any position that's going against you, because the level of sophistication might not be there to actually handle it and to know how you're to know how you're managing that? Or do you think that is fine?
There are 2 types of individual traders. Most individual traders don't look at charts, right? They just think, I want to buy whatever, NVIDIA, right? So they buy NVIDIA or Apple or whatever. And I said a few minutes ago, if you're trading the E-mini, you do not want your total risk to be more than 2 or 3% your account size. If you are an investor and looking to build a position and hold for 3 years, 10 years, you don't want your position to be more than 2 or 3% of your account size, right? So if you buy a position and it's 2% and the market goes against you, you cannot buy another 2%, right? Because that puts you over 2 or 3%. So if you're thinking about scaling in and you think that maybe 3% of or I don't want to risk more than 3% of my portfolio on this position, you determine what your risk is, you determine where you get out, and you can scale in, but up to a risk that is no more than 3% of your portfolio.
Yeah, very good. And when you're planning out your trades, you're in positions, do you already know ahead of time exactly when you'll be getting out? And do you ever make adjustments to that?
Most of the time I'm looking for swing trades, and I use many different definitions there are many things that characterize a swing trade. So on a 5-minute chart, I want to see at least 2 legs. I want to see a reward that's at least twice the size of the risk. And there's always, I don't know always, but 80% of days, 90% of days, there'll be at least one swing trade that has at least 2 legs, lasts at least 2 hours, and has a reward at least twice the risk. Okay, so those are the trades I'm looking for. But if you're going for a reward 2 times your risk, what does that tell you about probability? Right? It tells you probability can't be good. Right? You cannot have a high probability trade that has good risk reward, because nobody would take the opposite side of the trade. Right? If you buy a lottery ticket for $1 and you have a 90% chance of winning $1 million, who's going to sell you that ticket? Can't happen. So when you're trading, you're always balancing risk, reward, and probability. So if you see a trade where there's very little risk and you see a big reward, you're probably going to get stopped out, right? Because you cannot have small risk, big reward, and high probability. The better your risk reward, the lower your probability. So if you have great risk reward, you're probably going to get stopped out, right? And likewise, if you have a really high probability trade, your stop is probably very far away compared to your risk. And everybody takes these high probability trades. Let's say you bought Apple, and it's, I don't know, $10, and it's getting near the prior high, and your plan is to exit the position at the prior high. Okay, and your stop is, you know, $10, $20 away, and now you're only within $1 of your target. Okay, so at that moment, you're trying to make one more dollar, and you're risking $20, right? So you better have a very, very strong belief that it's going to reach your target, right? Because otherwise you're an idiot. All right, you know, but every one of us who is looking to exit with some kind of a limit order or profit target is in that position. When it gets really close to your target, your stop is much further away than the target. So, you know, you can only stay in the position if you're very confident that you're going to reach the target.
Yes. Now, you've referenced the 5-minute bars quite often, and you talk a lot about bar closings. Whenever you're talking, are you always referencing the 5-minute?
Most of my trades, you know, if you just count up the total number of trades that I do, most of the trades that I take are on the 5-minute chart. But as I said, I do take trades on other time frames. You know, for example, one of my favorite trades is a value trade. So you get a company. I have a very close relative who works for Snap, and ticker symbol SNAP, and the stock collapsed. So if I see a stock that collapses, and like 90%, and I have reasons to believe the company is not going to go out of business, and the market gets, let's say it was a $100 stock and it drops to a $5 stock, that is one of my absolute favorite types of trades, you know, because if it holds, dips below 5, doesn't go much below, and even if it stays sideways for a year or more, it's probably going to go up at least to 10 or 20 or 30 or 40. So probably that means better than 50-50. The most I can lose is $5, right? It can't go lower than 0. So I'm risking $5, and my reward potential is, you know, 2, 3, 4 times what I'm risking. And the probability is usually pretty good. You know, it's better than 50-50. So on Snap, I wanted to buy, Snap was collapsing, and I really wanted to buy it at $5. And it got to $8, right? And then it bounced around $10, $15. And then it came back down, and I said, okay, I'm probably not going to get it at 5. So I tried to buy it at $7.50, and then it got to $10, right? And now it's up at 17. So that's one of those examples where that's a great value trade, and it never got down to the price that I wanted, and it ran away from me. And whenever I want to buy something and it doesn't quite get to where I want it to be, and then it rallies, and then I raise my target of where I want to buy, and it gets down there near it and doesn't quite get there, and it bounces again, I know it's going to go up, but it's going to go up without me, because, you know, I wanted to buy it at $5, I wanted to buy it at 7.5, and, you know, so I'm laughing because, you know, I knew that when twice I tried to buy it and twice it get really close to where I wanted to buy it and rallied, that means there are a lot of people who want, you know, who are looking for the same thing, that looking to buy value and expecting it to go up. So Snap is at 17. I think it's going over 20 sometime in the next few months. So, but without me. So
yeah, very good. How important is the time frame for everything that you're saying? So if somebody was looking at this at a 1-minute or a 3-minute or a 15-minute, even with the way that you're analyzing the market, does this change drastically the probability of what you're expecting based on like a bar close on a different time frame?
You know, I said I have an encyclopedia of chart patterns, and I probably have 10,000 charts in the different categories right now, because I've been doing this for a number of years. And if anybody looking at the encyclopedia, the charts in the encyclopedia, will notice that I don't have axes. So I don't have price, I don't have time. And that's because markets are fractal. They create the same patterns on all time frames. And if I showed you a 1-minute chart or a weekly chart of the E-mini, you'll see the same patterns. And if I didn't tell you which chart was which, you probably wouldn't be able to tell me, right? So on television, if you see a trader, they don't say, "Oh, that's a weekly chart, and therefore I'm going to trade it this way." "Oh, that's a daily chart, I'm going to trade it this way." That's not how traders think. They trade all charts the same. So they just look for patterns on whatever chart they're trading, and they trade them. You brought up different time frames. I think you got to find your comfort zone. For me, I like trading the 5-minute chart. Can I trade a 10-second chart? Yeah, I can trade it for a few minutes a day, but I don't, right? Because you don't make all that much, and so you're doing the same amount of work, and you don't get much reward. And it just takes, you have to be watching things too intensely. And if you're going to be doing this for a career, you have to be happy. You got to be profitable and happy. And happy means not stressed out. And I think most people would have a hard time trading successfully long-term if they're trading more than 20 bars an hour. So maybe a 3-minute chart. Might be able to trade a 2-minute chart or 1-minute chart for short periods of time, 30 minutes, 40 minutes. But if you do that, you're not going to make enough money to make a living. So it's not worth it. Focus on a chart that you can just trade throughout the day. 5-minute chart's really good. I have a bunch of tennis buddies. They know me, right? They know my professional life, and they're always asking me stuff. And one of my buddies is he trades a 15-minute chart. And he says, "Al, I can't do the 5-minute chart. It's just too stressful. I can't think fast enough." He trades a 15-minute chart. And he told me he made $300,000 last year trading the 15-minute chart. So fine, trade the 15-minute chart. That's his comfort zone. That's what he trades. So it doesn't matter what time frame you trade. What matters is, are you comfortable? Are you successfully profitable? And don't worry that somebody else, if I'm trading the 30-minute chart, this other guy trading the 5-minute chart is going to make more money than me. Who cares, right? You're doing it to make money for yourself. You're not doing this to make more money than somebody else. You're not going to make more money than Ken Griffin. You're not going to make more money than Warren Buffett, right? There's always going to be somebody who does things better and makes more money. Your goal is to be happy and successful, and don't worry about, if your comfort zone is trading a 15-minute chart, or if your comfort zone is trading a daily chart or a weekly chart. It doesn't matter. Find a comfort zone where you can trade profitably, and you're going to make a ton of money. One of the reasons why people day trade is their accounts are small. They don't have a lot of money, right? And so they need a high percentage of return on their investments. But what happens is, the more money you have, once you get $500,000 or $1 million, you start buying stocks, looking at the daily chart or the weekly chart, and the total dollars that you make, it can be substantial. It can be significant, right? So, if you get enough money, you can't day trade all your money. I don't want to day trade all my money, all right? There's too much risk. So the more money I have my day trading money, and then I got this other money. I get accounts everywhere. I got a whole bunch of accounts, and I trade that money based on daily charts, weekly charts, and monthly charts, and that's my investment portfolio. And I just let it sit there. But active traders, the shorter the time frame usually means the smaller account size, and because you need a lot of money, so you need a very high rate of return, and you need a lot of trades, and but you got to be happy. And I tell traders, the goal, there are different steps, and the one thing that draws people to trading is they want to get rich. I saw Ken Griffin. He's a rich guy. I want to be like Ken Griffin. I want to be like Warren Buffett. But none of them started rich. They all started small. And your first goal is to stop losing money. Okay. And when you start trading, you should trade the absolute smallest position size you can trade. So you can trade 10,000 in euro versus the dollar. You can trade one micro E-mini. you just trade really, really small, and you're going to say, wow, I was a successful businessman. I sold my business for $5 million, and I could trade 20 E-minis or 100 E-minis. You're a fool if you do it, right? Even if you have a $5 million account, you start trading one micro E-mini, and you don't just do it for a week or two. You do it for months, 6 months, and stop losing money, and then start to increase your position size. And and at some point you move up to an E-mini, and if you can start to make 4, 5, 6 points a day, several $100s a day, you can start to make money for living expenses. And if you can then increase to multiple E-mini contracts, you can make doctor and lawyer money, and you can have a pretty good lifestyle. And if you can trade 10 E-minis or more, you can make an outrageous amount of money. Again, not Warren Buffett, but you can have a really nice lifestyle. So
For sure. When you are through all of your analysis, do you always do time-based or anything with range bars? Does this change analysis quite a bit? And is there a reason why you don't you use time?
Yeah, I've tried everything. If you've been around a long time, you try everything. And believe it or not, I used to be young, and when I was young, I had all this energy. I tried everything. So you name the type of chart, I've traded it. Okay. I like time versus all the other charts because I like predictability. So if I'm trading a 5-minute chart, there's a rhythm to it. I know every 5 minutes the bar closes, and I can make a decision about what to do. And with range charts, all of us, you get these sudden moves. And same with if you do tick charts or volume charts, you don't get that rhythmicity. And also lines, trend lines, I think are more precise on time-based charts. And you can say, well, Al, if I trade a range chart and each bar is 5 points, I'm getting in relatively early. Well, let me get a sip of water here.
Yeah, please.
If the market is going up on any time frame, most of the bars are going to be bull bars, and most of the bars are going to close near their highs, right? So yeah, you get that range bar, the reversal, and it closes near its high. Well, guess what? That market is not going to go up unless on all the time frames you're getting bars closing near their highs. So just wait for, let's say you're trading a 5-minute chart, wait for a 5-minute bar to close near its high, and then buy just above the high of that bar. If the bar instead has a big tail on top, a big wick on top, don't buy it. Wait until the next bar. And you can say, well, Al, no, I'm buying too far above the low. Fine, trade small. You're buying because you're looking for a swing up. And I said a swing is usually a couple legs at a minimum. The reward is at least twice the risk, and it's probably going to last 20 bars or so. So if you don't enter until bar 4 or 5, you still have 15 bars left, right? So don't worry about it. And and a lot of times the range charts, I think a lot of, I don't know, you got to be super quick. If the bar suddenly becomes 5 points, you got to be super quick, and it's hard to anticipate. Whereas on a 5-minute chart, there are 15 seconds left, there are 5 seconds left, and you can be ready to enter. In the range chart, a lot of times you just get or tick charts or volume charts, you get these sudden surprise bars, and it's hard to enter. And if you don't enter right away, you feel bad that you didn't take the early entry. But if you trade a time-based chart and you're looking for a reversal up, you wait for a bull bar closing near its high and just take it. And you're really not gonna miss out on anything.
When you are entering into trades, you've mentioned quite a few times about entering in as it breaks through, let's say, the previous high or the previous bar close. When you're doing this, are you entering on a sort of momentum into the trade and never entering on, let's say, a pullback?
I do everything. Okay. For most people, if they're looking to sell, they should be selling with a stop one tick below the low of a decent sized bear body, closing near its low. If they're looking to buy, they should be buying with a stop one tick above a good bull bar. So the market's at least going their way. But I sometimes will buy a big bear bar. I sometimes will sell the close of a big bull bar. Why is that? Okay. Let's say you got a strong bull trend and it's bull bar, bull bar, bull bar, bull bar. And then you get a bear bar closing near its low. Okay. Are you going to get a bear trend? Is that going to be the start of a bear trend? No, it's a bear trap. So it's a stupid short. So I'm going to buy it. So as soon as I see that bear bar closing near its low, I'm going to hit buy the market. Okay. And the opposite is true in a bear trend. If you get a series of good-sized bear bars closing near their lows, and then suddenly you get a bull bar closing near its high, well, guess what I'm going to do? I'm going to sell because chances are it's a bull trap. It might go just a little bit above, but it's probably not going a lot above.
Would you say it's generally or always a stupid decision to put on a trade and take it off within, let's say, the range of a previous bar?
It depends on disappointment, right? I talked about disappointing bars before. And let's say you're in a buy the close rally where bar after bar is a bull bar closing near its high, and then you get a bear bar. And if you're disappointed, right, you bought because you thought it was a buy the close type of bull trend, a bull trend where you could just buy at the market, buy close of a bar, buy above any bar, and then you get a bear bar. It's no longer a strong bull trend. So if you just bought thinking it was a strong bull trend, it's perfectly fine to get out, right? And once you start getting bear bars or bars with lows below the low of the prior bar, it's no longer a breakout phase. You're probably in a channel. So it'll go up a few bars, pull back a couple bars, go up a few bars, pull back a couple bars. And when the market is doing that, I tend to not buy at the high. I want to buy a pullback. So either, let's say I have a bull bar and the next bar trades below the low of the bull bar, I might buy with a limit order at the low of that bull bar. And if the market sells off for a few bars and then has a bull bar, I'll buy with a stop above the high of that bull bar. So during the breakout phase, I'll just buy at the market. Like today during that collapse, you got to sell at the market. You know it's going down, right? You know it's you got to be Forrest Gump, not Albert Einstein, right? You don't give a lot of thought to it. It's collapsing. Maybe it's going to go down more, right? You just sell at the market and trade. You say, I don't want to risk that much. But trade small, 20% of your normal position. So, and during a strong breakout phase of a trend, let's say a bull trend, I'll buy at the market, I'll buy the close, I'll buy above bars, right? And then if it pulls back and there's not a really good sell signal bar and there's not a good reason to think it's going to go down much, I'll start buying with limit orders below bars. So if there's a bear bar with a tiny bear body and a big tail below, I'll buy at the low of that bar. If it pulls back, maybe if it's a couple legs down and then there's a bull bar closing near its high, that's a bull flag. I'll buy with a stop above that bull bar. So, the weaker the trend, the more I want to buy pullbacks. The weaker the bull trend, the more I want to buy pullbacks. The stronger the bull trend, the more I just want to buy at the market, buy closes, buy above bull bars closing near their highs, even if I'm buying at the exact top of the trend.
When you start off your day and you're coming in, you mentioned having previous high and lows of day marked off, the overnight high and low marked off. Your preparation phase, is it very light? Do you mostly kind of no bias coming into the session and then you just start putting the context and maybe the story together bar by bar as it's happening? Or is part of your preparation building a bias or taking into account what's already happened in previous days?
Again, I'll go back to Forrest Gump. I just want to come in being stupid. If you think about it, every day is trying to form the high or low of the day early in the day, right?
Every day the market is trying to form the high or the low of the day early.
The high of the day comes in the first 12 bars 50% of the time. It comes in the first 18 bars 80% of the time, right? The first bar of the day is either the high or low of the day 20% of the time. All right. And the first several bars of the day, first 3 bars, first 5 bars, no matter how strong they're trending, there's a 50% chance it's the wrong way. So on the open, If the market is rallying strongly in the open, and so you get two big bull bars, I think, oh, that's pretty good. But if I get a bear bar, I'm going to short because it's a trap. It's a bull trap. The market, instead of forming the low of the day, it's forming the high of the day.
Hmm.
So I'm aware of support and resistance levels on the chart. I have, as I said, one chart where I have a bunch of lines for all that stuff. But most of the time, I'm not looking at that chart. Most of the time, I'm looking at the bars. For example, today, the market gapped down near the bottom of yesterday's trading range, and there were consecutive bull bars closing near their highs. That's a Forrest Gump trade. You just buy. You buy at a stop, one tick above that second bull bar closing near its high, put a stop below the first bull bar, and hold as long as it goes up.
I'm sorry, can you say that last part again about where you're buying and where you're exiting?
Okay. So if, let's say I have let's say I'm at a support level, the bottom of yesterday's trading range, and I have consecutive bull bars closing near their highs, I'm going to buy on a stop above the high of that second bull bar, and I'm going to put a protective stop below the low of the first bull bar, the low of the day.
Okay.
And a lot of times you get double bottoms on the open, so the market will rally, 5 bars, 10 bars, and then sell off to right around the low of the day, and it'll reverse sometimes a little bit above the earlier low, sometimes a little bit below the earlier low. So I'm always looking for that. And the opposite is true, sells off and rallies. Sometimes you get a double top. So on the open, I'm looking for strong breakouts up or down. I'm looking for strong breakouts to reverse up or down. I'm looking for wedge tops. I'm looking for double tops. I'm looking for wedge bottoms. I'm looking for double bottoms. And I don't come in with any bias. I learned long ago that, you come in and think, oh, I'm so smart, the market should go up today. Or, I'm so smart, the market should go down today. Nah. What you do is you follow what the market is doing. You wait for it to show you what it's doing, and then you jump on. You don't try to guess what it's going to do. You're guessing it's going to be 50%. On the open, strong rally, 50% chance it's a trap. A sell-off, strong sell-off, 50% chance it's the wrong way.
When you are, I guess actually let me back up to maybe a little bit more of your routine, because the type of trading that you're doing requires an incredible amount of just being present, being in the moment, and I should say all of trading requires this. The preparation portion that you do, is this something that you do every day as far as like meditations, or is it like an ongoing act as you're in front of the screens that help you not drift off and just stay fluid with what's going on, or what's your preparation like for, let's say, the mental side of what you have to do?
I had a tremendous capacity to experience pain and suffering 40 years ago, 35 years ago, trading. I used to, I can't believe it's doing this. And then I'd feel bad. And I'd feel bad for days afterwards. Al, you're such a fool. Why did you do that? You've done that same stupid thing 10 times. Now I don't care. Okay. And, not caring is one of the most important qualities a trader can have. Okay. You don't care. You don't look back at your mistakes. And I can't even, I know I suffered a lot. I'd be incredibly tense and upset for days after doing something really stupid. And now I know that I did it, but I no longer have those feelings. And it's because I'm at the point of my career where I don't care, right? I never care. I don't care if I lose. I don't care if I win. I don't care if I miss a trade. I don't care. And, so, I come in without any emotion. I just look at what the market is doing, and I try to find a pattern, and then think about some way, can I structure a trade that is there a profitable strategy here? Is there a way I can buy or sell and manage? And if I do that exact same thing 10 times, am I going to end up with a profit?
At the end of your day, you talked about the way that you log and categorize your trades. Is that the actual practice of doing that its own reward, or do you ever go back and reflect on these things at maybe the end of the week or something?
Yeah, every day. I've been doing it, as I said, since the mid '80s. I've been doing this every day. And by the way, I've looked at probably over 500,000 bars, 5-minute bars, watching them unfold one bar at a time, 5 minutes, five
Wow.
minutes. So I've done that for about 500,000 times. So I don't know. Repeat the question again. I just went off on the side.
Maybe even in the early years when you started doing this, but when the actual practice of going through and reflecting on the day to mark up that chart, is there an added benefit that you go back and reference these things, or is it mostly just moving forward, doing it every single day? That's the value.
I think it's my practice.
Mm-hmm.
Basketball shooter, basketball player is out practicing threes, right? I'm practicing recognizing chart patterns, and as I said, I sell access to it now, but whether or not I sell access to it, I'm going to do it anyway. I've been doing it forever. That's my practice. So at the end of every day, I spend about 30 minutes or an hour just looking at the chart bar by bar by bar, and I want to see what did I miss something real time. Usually I don't miss anything real time. Normally I see everything as it's unfolding, and so I know what the possibilities are. What when the market has done what it has done for these past 10 bars, I know what the possibilities for the next 10 bars will be, and and I see if I can structure a trade. So, but and sometimes I'll think of something. Oh, wait a minute! Yesterday I missed such something, and I'll create a chart for that thing that I missed, and I'll add that to the appropriate section in my encyclopedia. But most of the time, I see things as they're happening, and I don't miss anything. I don't go back looking at charts from last week or last month to see if I missed anything.
How many hours a day or a week do you think you put into trading?
Trade California time. I'm actually trading from 6:30 until 1:15 Pacific time. So whatever that is, 7 hours or so. And then I spend about 30 to 45 minutes every day creating charts. So it's basically an 8-hour day. And I don't take breaks, bathroom breaks or lunch or breakfast or whatever. I never spend more than 5 minutes on any interruption. Sometimes I'll have a doctor's appointment or something, or as I said, my kids will call. But I like what I'm doing, and I'm going to be doing it forever. I don't want. I have friends, who are retired. One of them is painting, and another one plays pickleball all the time. And I'll play some pickleball. I play tennis pretty regularly, but the thing that I like the most is trading. To me, I'm a fly fisherman. I like to hunt fish. I like to figure out where they're hiding and then try to catch them. And for me, that's a fun thing. And I think trading is very similar to fishing or hunting. And it's just fun. It's just fun to do. I enjoy doing it. I enjoy trying. I like to think. I like no distractions. I like to be sitting in a room with the door closed and just think all day long. Of all the things that I do, that is what I like to do the most. I like to think. Warren Buffett likes to read. He says more than anything else, he's reading all day long. He's reading about companies. And for me, I like to think about charts, and I like to see them unfolding. And my reward is either I took the trade and I made money, or the other reward is it does what I thought it would do. I find that satisfying.
It's been my experience, and I'd be interested if this is yours as well, that it's typically a bit easier if there's a trend being established for somebody to be able to join that trend. And if they find that comfortable, then they might have a very difficult time when the market is balancing, maybe doing something contrarian or getting in on some type of, fading a move as the market is going one way back into, let's say, value or back into range. So at some level, it's intuitively easier to go with the action, or it's intuitively easier to be fading the action, but it's difficult to do both, or at least intuitively be good at both. Is that an observation that you've had, or the idea of going with the action or fading it you don't really register it that way?
Yeah, I don't think that way. Right now, every bar, I think about what is the market likely to do the next 3 bars, the next 30 bars, and I want to take trades where I have a reasonable chance of having the trade go my way for 10 bars or 20 bars, and so that's how I'm looking at it. I'm looking for when I fish. One of my buddies likes to catch a lot of fish, so he catches a lot of little fish. I prefer to go out and look for big fish, and I'd rather catch one trout that's 22 inches than 10 trout that are 10 inches. So all day I see stuff and I take stuff all day, but I really like to get the big swing trades like we had today on the downside. And as far as different style of trading, I had a friend that I traded with online, I don't know, 15, 20 years ago, and he was a scalper, and he would take 20 trades a day, and he would just look for little scalps all day long. And then I had another friend, in fact, another example of this, the friend I mentioned a few minutes ago, who trades the 15-minute chart. He's just looking for 1 trade a day on the 15-minute chart, and he tries to get as much money as he can from 1 trade a day. And I'm always looking for swing trades, but a lot of times I'll see scalps. And let's say the market is in a fairly tight range, and it's unlikely to break out, but I see opportunities where I can make 5 points. It's like a little elf or a little leprechaun holding out a little bag of gold. And do you want this gold? Okay, I'll take it. So when the market's quiet, I will take scalps, but for the most part, I think I think most people should be looking for swing trades. And as I said, most swing trades are reversals, and you only have a 40% chance of making money. So that means a 60% chance you're not going to make money. 60% chance you'll make a little, lose a little, but you're never going to lose all that much because your stop is not too far away. Breakouts are my favorite. I've said a couple times about a bull breakout. You want a couple consecutive bull bars closing near their highs with decent sized bodies, both closes above resistance, and the body of the second bar completely above resistance. And the opposite is true for a bear breakout, which we had today. Those are very high probability trades, and the reward, the potential reward, just keeps growing. I said it's based upon some kind of a measured move from the open of the first bar to the close of the current bar. And if the breakout pattern keeps growing, the measured move keeps growing. Your stop gets further away, but the potential reward is further away. And those high probability trades, I'm talking about measured moves. Instead of a reward twice risk, I'm talking about a reward equal to risk. And when you have a high probability trade, you're not going to get reward twice your risk. Your stop is going to be far away. So in breakout trades, you're looking for a reward equal to your risk. Okay, so if you're taking a trade that's 70% certain to reach a measured move, what you're looking for is a measured move, a reward equal to your risk. And that's in a breakout trade, that's what you're looking for. In a reversal trade, your probability is less, so you need more reward. So you want to reward twice your risk.
Can I ask, you've mentioned a few times about being like Forrest Gump, and I think a big issue that I have actually is when the market is being very directional and it's extremely obvious that you just need to be joining the action. I find myself incredibly hesitant to go with it. And I think it might be a little bit on if something is a little bit too obvious, it kind of freaks me out. And I think just a little bit contrarian by nature. But I find myself sitting on my hands and missing a lot of directional type action moves. What would be your advice to somebody who, when they recognize that the market is getting directional, they have a very hard time getting on board with it or getting themselves to enter?
Okay. You care. Okay, that's a problem. All right, you're worried about losing money. I said you have two position sizes, your normal and then 20%. So 20% is really small. So that's what you do. You know, you become Forrest Gump and say, oh, consecutive bear bars closing near their highs, it's a buy. Now there's another bear bar closing near its high, it's a buy. And trade 20% your normal size and use the appropriate stop. And that's what you do. And then you got to, and then add to it as it goes your way. You know, you got to get to a size where you don't care, you know, where you're not thinking about money. When people are not making a lot of money, all they think, and especially if their account is small, they're thinking about one thing: risk, losing money, blowing their account, losing their dream of becoming a successful trader. So the fear of death of their dream as a trader. Okay, that is what is going on. You know, and you got to get past it. And the easiest way is trade the I don't care size. So you got to get down to a size where if you lose, you know, say, my dream as a trader is not going to die. You know, I'm going to be okay. And if you do that, you'll start catching more of those trades, and you'll make good money. All right. You know, as I said, 20% position. But if the move is, if the profit that you make is 2 or 3 times what you would make on a full size position, you know, you still come out pretty good.
And could you walk us all through the mechanics of, let's say you identify that the market is getting directional, and it might be a little bit more rare that it does maybe something like today where it just goes straight in one direction with no type of ebb and flow. What would be the dynamic for, as a trade's moving in your position, you continue to add to that, but on just some of the natural ebb and flow, you don't get that erased, or you don't get taken out of it?
You know, the easiest way is wait for a bear bar closing near its low, and you sell with a stop. One tick below the bar, or you just sell at the market. I'm going to take another drink of water.
Yeah.
I get a sore throat if I talk more than an hour or so.
Sure.
So that's the easiest thing to do. And you keep doing it until you're disappointed. A disappointment bar. And at a minimum, a disappointment bar would be a bull bar, especially a bull bar with a big body, especially a big bull bar closing near its high. And sometimes you can be disappointed by a bear bar. Now, if you're in a sell to close market, it's very hard for bulls to make money, right? All right.
Sure.
And a limit order bull might make a few scalps, but a stop order bull, a bull buying with a stop order, one tick above the high of the prior bar, he should not make money. Okay. But sometimes you'll be in a sell to close market and you won't get a bull bar. And what will happen is the market will go above the high of the prior bar, and it will go up high enough for a stop order bear, a stop order bull to make money. So if a bull bought with a stop above the high of that bear bar and he made money, a scalp, then the market is clearly no longer the kind of market that you want to be selling closes, right? So even though you didn't have a bull bar, if the market reverses the size of a scalp above the high of the prior bar, a bear bar, you want to get out. Okay. So instead of having a stop way up, right, and you see that stop order bulls are making money, they should not be able to make money if the market's still in a sell to close bear trend. You entered because you thought it was a sell to close bear trend, and now you see a stop order bull making money. It's no longer a sell to close bear trend. So get out and then wait for the next trade in either direction.
Yeah,
does that make sense?
It does. It does. Thank you. If anybody is potentially even new to you or knows of you and kind of sparked on some of this interest, I know you've written a lot of books and you have a lot of material out. Where would you suggest somebody as maybe this is the book you should get to start, or you know, the online course that I have to start with, or what would you suggest people do as a starting point?
I think at this point the videos are better than the book because you know, the book has a lot of text, and the course has a lot of charts. And as a trader, you're trading charts, so I think it's really important to see a lot of charts. So I think that is the best choice. As I said, I'm currently writing a new series of books just on charts. It's going to take me at least a year or more. If it takes me an hour or to create one chart, define the chart, create the chart, and I have 2,000 charts to go. That's 2,000 hours. That's a full-time job. Plus, I have my job as a trader, so it's going to take me probably at least a couple of years to get through that. But I think that will be, that's assuming I ever get through it. It's possible that I just say, "Oh, Al, you're dumb for doing this. It's just too much work." So I may quit doing it. Maybe I'll give it to one of the people who work for me and have them do the rest of it. But I think that will be a very helpful thing for day traders. It'll be 2,000 charts, lots and lots of examples of any pattern that they can imagine. But right now, the video courses, I think it's very good for traders, beginners and experts. It contains everything that I just talked about right now, right? And plus, it has a lot of charts. And as I said, I think if you're a trader, an investor, you don't have to look at charts. You can just look at balance sheets, right? But as a trader, you're trading charts. So I think it's really important to see as many charts as possible.
Very good. And then where is the best place to stay connected with you? Going to your website, going to your YouTube channel, another social media platform?
The easiest thing is just go to Brooks Price Action, or Brooks Trading Course. I have two websites, Brooks Price Action and Brooks Trading Course. But the easiest one is just go to Brooks Trading Course, and I have a lot of resources there. It has links to everything, books, the chat room, and the course, and a lot of free videos. So that's the best choice.
Yep, very good, very good. I know that we're out of time, and this was very much a water hose drinking from situation. And you gave me an incredible amount to think about. And I think everybody walking away from this should be very inspired on a few fronts. One of them, you really exude a high level of mastery. And I think one of the biggest issues in trading is it's very easy to get started, and it's very easy to not give the appropriate level of commitment and care for how difficult this is to do, and to do this consistently. And the way you talk and the way you reference, and it's very obvious that you live this as a lifestyle. And I'm motivated to up that level and to make sure my commitment level to this is high. And so I thank you for that. And there was a lot to just take away from this, and this would be a good thing to watch through a couple times, I'm sure. I wrote through a lot of notes, and I feel like I could keep this going for several more hours, but I know we must end. So I really want to just thank you again for coming on. We'll have everything linked in the description, and I'll give you the final word if you want to say goodbye, and then we'll wrap up.
Well, I appreciate you giving me the opportunity. And I hope that I was clear, and I hope that your viewers find it useful. And I wish everyone a wonderful holiday, and I wish them a great time as traders. And trade the I don't care size. You got to be doing this both for fun and profit. If you're going to be doing this for decades, you have to be enjoying it. And so you got to get you got to stop worrying about money, trade small, and don't worry about getting rich to start with. Just worry about learning how to trade, and then learning how to consistently be profitable, and then gradually increase your position size. And you don't have to have a very big position size to make a lot of money as a trader.
Very good. Those are great words to end it on, and we'll cut it right here.
Okay. Thanks, Aaron.